Hi, in the previous episode of Question of Money, I spoke about some of the money mistakes that I have made at the beginning of my career. But one mistake that I have not made is to bet a lot on IPOs. Many new investors think that they can get really rich by betting on IPOs and making listing gains. But they are quite wrong about this, and I will tell you why in this video. Hi, I am Aarati Krishnan. I am a consulting editor with Business Line and I have invested in the markets and tracked them for the last 25 years. So let me give you 4 reasons why you don't get rich actually betting on IPOs. So in theory, IPOs are supposed to be about small private firms tapping the public markets and raising money so that they can scale up in size. But in practice, what really happens is companies which have been private for a long time and have actually scaled up substantially, their promoters and private investors want to exit by selling their shares to the public at a high price. If you look back at the history of IPOs over the last 30 years from databases like Prime Database, you will find that the years when IPOs raised record money are years like 94-95, 99-2000, 2007-2008 and so on. These were the years actually which marked the top of previous bull markets. Promoters and founders selling shares in an IPO like to time them and bunch them up during the last stages of bull markets so that they can get the maximum price for their shares. The best way to create wealth in the markets is to invest when fear and not greed is the dominant sentiment in the markets. When people are trying to double or treble their money with IPO listings, greed is actually the dominating emotion. That is why IPOs seldom make you rich. So if everybody in the market is making money by trebling or doubling their money through listing gains, why shouldn't I participate in it, you may ask? This is because these listing gains are extremely difficult to predict. So have you played a game of musical chairs in a party? As long as the music goes on and everybody is going around, you are quite sure that you will grab a chair. But if you stop being alert even for a minute and the music stops at that time, you lose out on the chair and you are out of the game in an instant. Listing gains on an IPO are like that. Usually when the market is rallying every day and everybody is very bullish, the IPOs that come out in those markets, they manage listing gains. But if there is even a small market pause or the possibility of a correction, the IPOs that are actually caught out at times like that, they don't manage to deliver listing gains. The most famous example of this is the Reliance Power IPO, which came out in January 2008. Because Reliance Power was so much in the news, investors thought that this was a sure bet to give listing gains. In fact, grey market premiums were at 80% or so at that time. So this IPO attracted oversubscriptions for over 70 times the 11,000 crore that they wanted to raise. But this IPO closed on January 18th, and by the time it listed in February, the market had crashed some 4,000 points because of the US subprime crisis. As the US housing crisis unfolded, the market started to fall, and by the time Reliance Power listed, all the greed had gone out of the markets and there was a lot of fear. So Reliance Power finally listed at 372 rupees on the first day, and it just kept tanking after that, and investors in it actually lost over 80% of their money eventually. So this was just one example of how fleeting listing gains can be and how they can depend very much on the mood of the market when the listing takes place. That mood can change from extreme positivity to extreme negativity just in 10 or 15 days. So to make substantial money or to get rich on any investment, you should be able to bet a substantial sum on it, right? So when you buy stocks over time or when you do SIPs in mutual funds, over time it can actually compound to create lot of wealth. But IPOs are a one-off case. Moreover, most people don't realize that you get very limited allotments in IPOs. If you are an individual investor and are applying for less than rupees 2 lakh in an IPO, you come into the retail category. Now SEBI's rules actually specify how you will get allotment in the retail category. If an IPO is slightly oversubscribed, then all retail investors who have applied will get one lot. Usually one lot size is only 10,000 to 15,000 rupees in an IPO. Suppose the IPO is heavily oversubscribed, then what happens is there is a draw of lots. So based on lottery, the company decides which retail investors will get that one lot. So even if you turn out to be very lucky and get allotments in heavily oversubscribed IPOs, you still stand to get allotment only for 10,000 or 15,000 rupees, which is one lot that you have applied for. So imagine this one lot actually doubling or tripling on listing. Even then you stand to make only 30,000 rupees or 45,000 rupees. This is not going to make a big difference to your long-term wealth. Now to get over this problem, what some people do is they try to borrow money from banks or NBFCs and they make bigger bids, much more than 2 lakh rupees. Now this gets you into the NII quota or non-institutional investor quota. Getting into this quota also can be quite dicey because in this quota you get proportionate allotment. If an IPO is heavily oversubscribed, then you will have to apply far more than the oversubscription number for you to get allotments in the IPO. When you do this, you are taking a lot of risk. Suppose the IPO fails to deliver listing gains and actually delivers losses, you will not be able to cover your borrowing costs and can end up with paying the bank for your interest as well as taking a loss on your bet on the IPO. In the stock market, a lot of money is made only when you enter a stock at a reasonable price or valuation. Now, IPOs are all about promoters or investors who've been with the company from the startup stage trying to exit it by offloading shares to public investors. Now, I told you that IPOs are already bunched up in bull markets and the promoter or the investor who's selling you the shares is also trying to maximize his return or his price. So the combination leads to very high pricing for most IPOs. So when you buy into an IPO, you are actually buying into a share that the promoter wants to exit at that price. The promoter obviously knows much more than you about the business. Therefore, when you buy into an IPO at that elevated price, it becomes very difficult to make long-term returns from that price. So many investors, if they don't make listing gains on an IPO, they hang on to the share thinking that it will become a long-term wealth creator. This doesn't pan out either. So if you've been getting tempted to participate in the IPO listing gain game, stay away for now and try to invest that money in an index fund or a mutual fund. Over the long run, that may give you better gains than the IPO. So if you set aside IPOs and think of investing in mutual funds or stocks, one concept that you really need to know is about large, mid and small cap stocks. I'll explain about that in the next episode of Question of Money.